Hello everybody, Alex here. Welcome to my finance and accounting education channel here on YouTube. Today we are going to talk about buying the dip, which is a concept which you will find in many articles, TV shows and so on and so forth. What does it really mean? And we have some interesting opinions about buying the dip, and I personally think that the opinions expressed by that person, and we will see who's that person exactly and in which article and so on and so forth, are quite dangerous, and they need to be debated from my point of view, because it looks like they are being preached, some ideas are being preached to the investors, and it looks like it might be a good idea to do what it's told there, but it doesn't have any fundament. But before we jump right in, I'm going to ask you to subscribe to my channel, to hit the bell notification button, and you will never miss an update on my site. I do them quite regularly these days on Tuesdays, Thursdays and Sundays. You should expect new and hopefully interesting videos from me. That being out of the way, let's jump right in. So we have an article from CNBC which is quite old, June 17th, so we are not going to talk about the week, look for more selling pressure in week ahead, so that week is already past, but we are going to focus on some, let's just say, some statements which are present in this article and which are very interesting because they talk about buying the dip. Just one short word, what's buying the dip means is at the share prices. So if you have favorite companies in which you want to invest, maybe you are already invested or you want to buy them for the first time, of course there are cycles, the prices go up and down and so on and so forth, and buying the dip is just simply buying that share when the stock has dipped, so when the prices are lower. I know this might come as a surprise to everybody, but essentially to make money on the stock exchanges, and I'm quite sure you are not prepared for this, and this is a very complex concept which you probably have never heard, and will be very surprising for you, and I urge you to take a pen and paper and to write this down. But in order to make money on stock exchanges, you need to buy low and sell high. Oh, I know this might come as a surprise, but if you do the other way around, you will lose money on stock exchanges. But however, there are guys like this one here, Bank of America equity strategist Ajay Singh Kapoor, which somehow manages to advise the people otherwise. And it's no surprise, because if we go to another article from March 27, 2022, it says that new report finds almost 80% of active fund managers are falling behind the major indexes. So if you are wondering who are these guys which are, so 80% which cannot keep up with the indexes, I'm quite sure Ajay Singh Kapoor is one of them. What he said exactly? He said in a note to clients on Friday that it is time for investors to stop fighting the Fed. So first of all, the investors are not fighting the Fed. It's wrong from the start, and the Fed is not fighting the investors. The investors want to make money from the stock exchange. It's very simple. Fed has nothing against it, I'm quite sure. But also it's not, let's just say that, not only that it has nothing against it, but Fed is more interested in the macroeconomic stability and keeping the prices low, keeping the inflation low, having decent unemployment and employment numbers, having decent evolution on financial markets, including stock exchanges and so on and so forth. So there is no competition here. So from the start, the premises are wrong, and give up the buy the dip mentality. So story is that probably this guy and Bank of America and many others have this strategy of somehow attuned to a bearish market right now with short selling and so on and so forth, and they are probably, this is presumptuous already from me, that they are pissed off that the markets don't go down faster or as much as they would want, and of course that they are advising the investors to abandon the buy the dip mentality. So basically stop buying low and selling high, and do the other way around, I think. I mean, there are not that many things which you can do right now in this market. You can hold, if you have something, you can sell or you can buy, in a bear market, heroism is punished, whatever that means, heroism. Valor is unnecessary, and cowardice is called for in portfolio construction. This is the way to preserve capital and live to fight another day. Waiting for the next central bank panic and better valuations and the new earnings upcycle, Capuro. So basically what he's selling is that you should sell everything, in a bear market. It's not clear if he's also pro holding, but under no circumstances you should buy assets which are cheaper right now, which is surprising, because we already know from Warren Buffett you should be greedy when others are worried, and you should be worried when others are greedy. So there is no better time to buy shares than when all the others are selling, because the prices are reduced. And of course, if you want to buy low and sell high with high prices, buying right now is a good idea. Now, if you have a long-term strategy like I do, you will buy regularly. You will add to the companies that you like, or to new companies that you like. So you might already have these titles or so in your portfolio, or they might be new, but you will add regularly, so you will automatically buy the dip. If you are trying to time the market, that's quite difficult, and of course a share that it's down 20%, let's say, it can also go 25% or 30%, so you might not be able to time it perfectly, but still buying the dip, it's a very good idea. I don't understand what he's trying to preach here. So just pull your money with a loss out of the market and wait till the market turns. And what if you are then not timing the buying perfectly, and you are buying the shares back with a price which is higher than the one at which you sold them? And what's he actually trying to preach here? I mean, it's very weird, this statement. And I'm taking an example. We are taking the company Meta, shares at $163 on 17th of June, so last week basically. If we have this chart of 5 years, if you are trying to somehow preserve your capital, the chances are that you are going to sell, and you are selling at this price, or you are sold at this price, the chances are that you are selling at a loss. There is no doubt about it, unless you have bought the shares. I mean, the price was similar in March 2020, at the start of the pandemic year, maybe a little bit lower. So if you bought with 149, you will make a little bit of profit right now and selling it with 163. Or you should have bought the shares somewhere before end of 2018, to be sure that you are making a profit. Otherwise, if you have bought the shares between 2019 and 2022 present date, you will make a loss on selling the shares. So basically he's advising you, this guy, to take the loss. That's what he's advising you. And why is it makes absolutely no sense, because if we are looking at this S&P 500, we have year to date 18.45% loss. We are on a recovery, so if we take like 17th of June, it was down with more than 20%, and it makes absolutely no sense if you are thinking about it with these bearish markets and the concerns about the economy and about the GDP drop. What it means is that compared with the end of 2021, you would expect to have a recession which is so deep and so prolonged that it's wiping out 20% roughly of the current value of the future earnings, or the intrinsic value as Warren Buffett is calling it, which makes absolutely no sense. Have you heard of a 20% recession in history? 20% recession which is prolonging on many years, so that it's affecting the earnings of the company for so many years in the future that it will reflect in the current value of the company and so on and so forth. No, it doesn't make any sense. And all this drop in 18.45%, it's not, let's just say, because you will say, okay, why aren't they correlated? If we are expecting like a 2-3% drop in the economy, in a recession of 2-3%, why isn't S&P 500 dropping with only 2 and 3%? Because they are not correlated. The S&P value will be based on real people transacting, and it may be individual investors or institutional investors, people selling and buying shares. And the more the people are affected by fear, the more they will sell. And it's clear that there is a lot of fear here, irrational fear. So fear is neither wrong nor right, it's just a feeling, and this just is as it is, yeah. And the second sentiment which is always affecting the markets is greed, which is the other one, when you will see that the valuations are very high and the PE ratios are very high and so on and so forth. What I'm saying, it makes absolutely no sense, because then you could say, okay, but it wasn't making any sense in December or in the first 1 or 2 weeks of January either, when it was at the peak. And I would say, like, okay, we need to have a reference term if nothing makes sense, but still this is the reality. And talking about the GDP, you have the annual growth of real GDP in the United States of America. I'm just trying to show you that 20% doesn't make any sense. So you had several years in negative in 1930, minus 8.5, minus 6.4, minus 12.9, but immediately jumped back to plus 10.8, plus 8.9, plus 12.9. And if you are looking at this evolution, these are just the pluses and the minuses. You will see that there are a lot of years with plus. There are some years with minus, but it's never more, so the scale is to minus 15%, so it's never more than minus 50%, or less actually than minus 15%, so minus 20, minus 30 or something like that. I think the values are correct, because if you look, we have a minus 3.4% in 2020, minus 2.6 in 2009. So basically the stock exchanges, let's say that they are overreacting always to these cycles. Probably they are also overreacting. I mean, it's clear that they are overreacting to the perspective of a recession, but they are also overreacting to the economic growth, yeah. And since these are only the growth, or the, let's say, losses in GDP per year, I wanted to show you that, for example, if you are going on S&P 500, you are going on the maximum, the market is essentially bullish, yeah. So it's not bearish, it's not starting high and going lower and lower, but it's the other way around, yeah. So it's growing, it has a tendency to grow. And you will see that this is the same case with the GDP, yeah. So we have the real gross domestic product from 1947 to 2022, and of course there are negative periods when the GDP is going down, like it's clear in Q2 2020, like we had in 2008, 2009 with the great financial crisis, and so on and so forth. And I think the less favorable periods are marked with gray, but you see that the tendency is always to go up, yeah. So it doesn't make any sense if you would follow the stock exchanges probably, and if you think about the anticipation of this recession, you would probably see that the stock exchanges are going more down before, let's say, the recession, and then they are climbing faster up. So the variance is a little bit, let's just say, more ample than the one in the GDP. But however, this is the point, and I think this is what you should take from today's explanation, that the minus 20% doesn't make any sense. It has been, there have been several situations it went even lower, I think minus 30%, minus 34 at some point. The stock exchanges went lower, but in time this is recovering. So If you want to have a short-term strategy, you can do whatever Ajay Singh Kapoor of Bank of America is telling you, but on long term, what he's saying here, it doesn't make any sense. Yeah, so trying to time the market, and of course, if you are trying to wait for the exact button, you will probably not succeed. If you have sold at some point and you are waiting to get back in at some point, you might also not be very successful, and so on and so forth. But just as I have said, buying the dip, it's offering you the opportunity of buying a preferred stock, so a share of a company which you already have or not yet, at a discounted price at that moment. So it's by no means a bad thing to do. And just as I have said, the economy is always going up. There might be some hikes in the roads, but after the recovery it will be higher than before. And it makes absolutely sense to keep buying the dip if you are a long-term investor and you believe in those companies. Don't do what this guy is telling you, which is anyway not very clear, because it's like using a very elaborate, and so it's like sounds like Moses delivering the 10 commandments. He's not saying that you should sell, but he's also telling you that you should not buy. Probably he's advising the people to hold on to the money, which is trying to time the market and to wait for the news cycle, because he's saying that you should wait news valuations and new earnings upcycle, which I wouldn't advise. That's it for today about buying the dip. I hope I have clarified a little bit the concept. Just as I have said, in order to make money on stock exchanges, you need to buy when the prices are low and sell when the prices are high, and not the other way around. Of course, if you have sold at a certain, if you have bought an asset at a certain price, that doesn't mean that the next day it cannot go lower the price. It's very hard to time these things, but it's worse to just stay with the money and wait for it's proven, actually there are studies which are proving that waiting for the perfect conditions will make you less money than just regularly when you get your paycheck and you get some savings and you can invest some money. Just invest in the companies that you like and think about it long term and what are the perspectives for the company, for the sector, and so on and so forth. And don't base yourself on, oh, this is a bearish market, we all need to sell, or something like that, you know, or we need to short sell or whatever. If you like this video, please hit the like button, share it with somebody that might be interested about this concept of buying the dip. Commenting in the comment section if you have something to add to the topic. But most importantly, please do not forget to subscribe to my channel, hit the bell notification button. It doesn't cost you anything and it will help me a lot. You will never miss an update on my site. I do them quite regularly these days on Tuesdays, Thursdays and Sundays. Should expect new and hopefully interesting videos from me. Below this video you have links. You can create any Toro account and trade there without a commission or a fee, which is always a saving, no matter how often you are trading. Once per day, once per month, once per quarter, once per year. Not paying a commission or fee is always a saving. Be careful though what you are buying there. If you are trading leveraged, you will only get access to CFDs, but they also have titles which are available either only as CFDs. One example would be the Saudi Aramco. There are titles which are available as both CFDs and the shares themselves. One example would be any, but also there are titles which are available only as shares, so there is no CFD associated to it. I'm just disclosing this information for you to make you aware of what you are actually buying. CFDs are derivatives, contracts for differences, which are mimicking the price of the share, but they are not the shares themselves. Also remember that losses are always possible, and the past performance is no guarantee for the future performance. So if you made some gains in the past, that doesn't mean you will also make the same gains or more, or you know, in the future. And below that link you have another one with an Amazon wishlist with hardware and software items which can help me improve the quality of my videos. That's being beneficial also for you because you'll get better videos from me. But let's just say that from financial perspective, that is the most inconvenient for you. The easiest way to support me remains to subscribe to my channel, to hit the bell notification button, and of course to continue to watch my videos. Once again, my name is Alex Petrescu. This is my finance and accounting education channel here on YouTube. I thank you today for your patience, and I look forward to presenting to you with the next opportunity. Goodbye.